The longer the wait, the harder the fall. Talk of a recession has been on investors' minds for some time, but could everything come crashing down before we know it? Joining me today is Bob Thompson. He's the Senior Vice President and Portfolio Manager over at Raymond James. Bob, welcome back to the show.
Good to be with you again, Daniela.
Yeah, good to see you again. So, Bob, let's cut right to the chase here. You know, where is the economy headed? Risk assets are still climbing, and safe havens like gold are just stuck. Are market fundamentals detached from market perceptions?
Right. You know, it's kind of back to the future. I think we're in right around 1999, 2000 right now, right? A lot of the risk assets, people keep piling into them. You know, the Ubers, the Lyfts, these IPOs are coming out, and people are throwing money at companies that aren't necessarily making anything. And of course, it's to the detriment of a lot of the undervalued companies, value stocks, anything that's kind of non-high growth. And that includes the mining shares are getting overlooked right now. You know, it's interesting what you said about the risk assets are still climbing quite a bit. You know, any bull market, the stronger the bull market, and this has been one of the longest ones in history for the U.S. market, it's hard to kill a bull, a really strong bull, especially one that's been going so long. And each market drop that we get here, you see it comes back to the market highs again. And we're right there again. Everything that was lost in December, it's back to the market highs. And it does that a lot at the end of bull markets. As I said, bull markets are hard to slay. You got to put a lot of swords in the bull at the end in order for people to realize that the bull market is dead. And I think that's where we are right now.
So, you know, Bob, does this market euphoria that we're seeing, does it remind you of any cases in recent history where a market crash happens right after? You know, and how bad could the next potential downfall be? Well,
you know, normal market corrections are 40%, right? It happened in the 1973, 74. You know, 1987 was 25% in a day, but that correction was around 30. Then we had 2000 to 2002 was down about 40 in the S&P. So, you know, 40 to 50 is normal as far as market drops are concerned for the general market. So, you know, nobody can believe it at the top, but that's just a normal sort of event that happens, because at the end of any bull market, the frothiness is so much that people just don't believe that it's ever going to go down again.
I wanted to just mention, you brought up the miners before, Bob. And when we spoke back in March at the PDAC, you talked to us about the mining clock and how we were 1/3 of the way through a bull cycle. Where do you feel we are at now?
Great point. I think, you know, the mining clock is really a credit clock, because you need access to credit, you need access to capital in order to make discoveries and have the industry grow. And that's severely lacking right now here in North America. But somebody's filling the gap, and that's Australian companies, right? We just had Atlantic Gold get taken out. Newcrest has been very active.
Right. So what do they know that the Canadian miners don't know?
Well, they have access to capital. The market is a lot better. People are willing to give them capital. I mean, this Atlantic Gold deal probably would have never happened here in Canada, but in Australia, they were able to get it done. And I think one of the reasons for that, we've got the cannabis frenzy right now. A lot of risk capital is going into that. They probably don't have that in Australia. Their companies are cash flowing nicely, and they're filling the gap right now. So I think we're still in the same spot in the mining clock. We're around 6:30. We're getting cash takeovers, right? And that's what's important. People in the industry know what's happening. They know there's a lot of value there. And although the general public isn't really interested yet in a lot of these mining stocks, people in the know are seeing the value, and they're buying these companies out for cash. And that's actually a pretty healthy part of the market.
I remember one quote you referred to by Howard Marks, an investor, that sometimes the difference between being early and being wrong is indistinguishable. So how does that translate to mining and the fear of missing out on the next big discovery?
Well, I think, you know, the first part of a bull market, which I think we're in right now, started at the beginning of 2016 for miners. Most people miss out on because they don't really realize that we're in a bull market. And there's a lot of naysayers, and we've heard the proverbial, you know, climbing a wall of worry. A bull market climbs a wall of worry, and that's where we're at right now. When Howard Marks said that, you know, he was talking about any asset, and it's perfectly true. I mean, a lot of people were saying back in 2005 and 2006 that we were in a credit bubble and there was going to be some sort of catastrophic collapse. Well, they kind of looked like idiots for a couple of years, and then they were proven right. You know, Warren Buffett said in late 1999 that the tech bubble was going to come crashing down, and he looked wrong for about 6 months to a year, and then he suddenly was proven right. And I think a lot of the people that are talking about this, the mining sector right now, and it's less and less as each year drags on, there's less and less believers, and I think the market's gonna rally that much more when it does, because people forget this is a cumulative effect here. The longer this drags on, the more the supply destruction in the metals, the greater the bull market will be when it happens.
Bob Thompson, it's always a pleasure speaking with you. Thank you so much for joining us today.
Thanks a lot. Talk to you later, Daniela.
Sure thing. And thanks for watching. We'll be back tomorrow.